This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Welcome back to Business Breakdowns. Matt Russell here with a special two-part episode today on private credit. In 2023, the global private credit market topped $2.1 trillion in assets and committed capital. And for a market that really emerged in the 90s, that growth is enough to warrant the attention that private credit receives. But rather than having the blanket statements like private credit is an emerging bubble, we wanted to explore the various segments of private credit, ask simple questions like, where is this growth coming from? Take a closer look at the supply and demand, and capture some of the nuance that is so important to any of these conversations and these looks at these emerging markets. To start, we use the lens of a successful fund manager in the space. Our first guest, Armen Panossian, is co-CEO of Oaktree. And beyond Howard Marks' famous memos, Oaktree is a $192 billion asset manager known for its long history in credit. Armen leads the firm's performing credit business that spans liquid and private markets, which we will be focusing on today. Armen joined Oaktree in 2007 after previously having worked at Morgan Stanley. And while I can't say that there's a traditional pedigree for investors, Armen does stand out. He earned his BA from Stanford, and he also earned his MS in health sciences from Stanford Medical School. You'll see that comes into play during our discussion. He also received a JD and MBA from Harvard, which plays a very important role when you talk about legal documents, which are so important in private credit markets. In part two, we talked to Josh Clarkson, Managing Director at Prosek Partners. Prosek focuses on communications and marketing for financial services funds and firms. Josh advises alternative asset managers and many private credit managers on strategic communications and investor relations. And Josh has had a front row seat to many of the dynamics driving inflows into the asset class. We hope these conversations give you a better sense of what's going on in the private credit ecosystem, the difference between strategies and wrappers, the demand for private credit solutions, how regulations have played a role within this market, and much, much more. Now on to part one and our conversation with Armen. All right, Armen, I'm excited to have you here to cover a wide range of topics on private credit. And a place to start that I thought was interesting was in a recent interview. It was the topic of the bubble in private credit. And your response was, what you see now is still this mismatch of supply and demand, where there is an undersupply for the amount of demand that's in the market. And it really caught my attention. I thought that was a good place to start right there. Can you talk about those dynamics, whether you want to talk about the supply side first or talk about the demand side first? What is driving that mismatch, which still makes it an attractive asset class in your eyes?
Thanks, Matt. And I appreciate you having me on. So I think the way to think about private credit and periods of time where supply and demand may be matched or mismatched, it really depends on the time frame you're looking at. So in any month-to-month period, there may be a slowdown of deal flow, and therefore an appearance that there may be too much capital chasing too few deals. But over a medium or long-term period, as you look at the sheer dollars of dry powder from private equity firms that wants to get deployed, needs to get deployed in private equity transactions, and you look at the size of both the public and private credit markets, there's just a really big mismatch in terms of the need for financing and the supply of that financing. Now, because base rates are so high right now, over 5%, and because spreads for a private loan, even the most simple private loan for a private equity firm buying a new business has a spread of about 500 basis points, the cost of borrowing on a first lien basis for that private equity firm is north of 10%. And that's pretty expensive relative to the return on equity that a lot of private equity firms model. But it's also very expensive relative to their expectations of what the rates should be or were just a few years ago. So the deal flow, the LBO deal volume is meaningfully lower in this high base rate environment. And in the meantime, because private credit, for the most part, is a floating rate asset class, there has been a significant amount of inflows into BDCs and other vehicles, both institutional investors and retail investors. So in any given month, it may appear that spreads are tightening and that there's too much capital. But as you look at the trillions of dollars of private equity dry powder out there, and you look at the roughly $300 billion of private credit dry powder that's out there, there is a really big need, or an expectation that there will be a big need for financing of both the private markets and the public markets to supply that private equity deal flow.
And if we can go back in time a little bit, global financial crisis, I know you joined Oaktree right in 2007, right prior to the real change in terms of the markets. And I think one of the original thesis for a secular growth in private credit was banks no longer being able to hold a lot of this esoteric credit on their balance sheets, de-risking the balance sheets in general. How much is that the driver of this huge secular growth in private credit? How much does that still play a role? Is that story over with? If we could just kind of start at the beginning of time there, how much of that is the fact and what else has played into that growth?
I think every time that the public market, as well as the regulatory environment, has failed to provide an adequate solution, the private markets have filled in. So we could go back to even before the financial crisis. In the late 90s and early 2000s, there was a growing middle market private equity community. It just didn't make sense to issue a high yield bond at that time because you needed to have kind of a minimum issue size of 125 or 150 million. You needed to go through a ratings process. It was kind of costly. You had to get a bank to syndicate it for you. So there was just an accessibility issue. So what happened was there was a creation of a private credit instrument, mainly mezzanine finance. That's when it was born, late 90s, early 2000s. And it was a private credit solution to what is really a high yield type instrument, a junior instrument that was sat behind a bank financing that helped a private equity firm get a deal done. And that was the beginning of private credit. Now, between 2000 and 2007, private credit had grown to maybe 200, 250 billion in size. And again, mainly a junior instrument. And then the global financial crisis happened and Dodd-Frank and other regulations stepped in. Bank activities and trading desks meaningfully shrunk. And so there needed to be an expansion of the private markets to fill that gap. And so the markets went to first lien private credit, went to unitranche private credit, which is essentially first lien plus some junior or second lien kind of wrapped into one larger financing. And they even started to do bigger deals. Deals that would have ordinarily been done in the syndicated bond or loan market started getting done in the private credit market. So from 2007 to today, we've seen about a 5x increase in the size of the private credit market. It went from 250 to now nearing $1.5 trillion. Now, as we look at the conditions in the market today, we did see a dislocation in 2022 when SVB collapsed, Signature Bank collapsed, and we also saw a lot of hung loans on Wall Street. And what happened is the private credit market expanded yet again. It went even larger scale. You could do a $2 or $3 billion private loan now if you're a private equity sponsor and you have certainty of execution. The benefit of private credit versus public for a private equity sponsor is that certainty of execution. You don't need to go through a 6-month process, going through a syndication, a ratings process. At any point, it could fall down. So private equity firms now understand the value of that certainty and are supporting both the public markets and the private markets. They want a healthy competition between the two. They don't want one to dominate the other. And now private credit managers are doing even bigger deals. There is yet another dislocation that's happening now, and that is the Basel III endgame regulation. And Basel III is something that we've seen in Europe now for a while, or the Basel regulations generally. But the effect that it's having in the US is that investment banks as well as regional banks are exiting legacy areas of lending to small and medium-sized businesses, certain types of consumer finance or specialty finance. And it is creating an opportunity for investment managers, yet again, the private credit community, to step into that, what we're calling asset-backed finance area, to fill in where these banks are stepping away now because of regulation. So every time that there's a market failure or every time there's a regulatory shift, the private credit community responds, grows, and frankly maintains that market share until the next regulatory shoe drops.
Yeah, it's really interesting where I could have imagined part of that being cyclical, but it really does feel secular with a lot of the changes. And you mentioned there the deal sizes. If you would have told me 10 years ago that private credit deals could be at the size that they're at today, north of $1 billion, I would have said no way. And I think you mentioned one of the important dynamics there, which is the relationship between sponsors and the private equity funds and these private credit lenders. Can you talk a little bit about that? Because it requires a healthy relationship where neither side is taking too much. I think you've been very much at the forefront of driving the relationship, at least from Oaktree's side, and had a front row seat in terms of what makes that work. Can you mention that and then maybe mention during periods of stress how that's gone?
It means that you have to pick and choose who you do business with. You can't be all things to all people, provide loans to all private equity firms for all of their deals. You really have to self-select to a smaller set of private equity firms that you think at least have subject matter expertise in particular sectors, do a really good job in terms of constructing their deals and executing them. And frankly, you really want to do business with the private equity firms that treat their lenders right. And from the private equity side, what they want is certainty. They want speed and certainty. That's really the advantage of private credit. So when they do business with a lender, they want to know when the lender says, yes, I'm good to go, that they indeed are good to go. If they say they're good to go and then they pull out at the last minute, well, that introduces the same execution risk that the public side does. So for Oaktree, I think especially, we have a very balanced private credit platform in that we are sort of equal parts opportunistic credit as we are performing private credit. And so we have a solution for private equity firms in both good times and bad times. In the bad times, it's a capital solution. It's a rescue loan. In the good times, it's kind of the plain vanilla first lien sponsor loan. We certainly have had tougher conversations with private equity firms, but I think private equity firms are pretty sophisticated folks. They know when they're kind of out of the money, and sure, they'll try to kind of test the limits or the boundaries of it. The challenge is to make sure that it remains sort of a respectable negotiation. And we've had a great relationship with the private equity firms, both in challenging situations as well as in situations that worked out great for them and frankly, pretty good for us too.
When you think about the competitive landscape in the private credit markets, you mentioned there that private equity funds are trying to basically feed both sides of the individual private credit funds and the banks. Do you consider banks competition in your world?
I think just as much as they are competitors, they're often partners. There are times where banks say, look, I want to come up with a solution for this private equity firm on a deal. It requires maybe a second lien, a privately placed second lien. Maybe it requires a private first lien that sits alongside of a syndicated first lien. So they certainly do compete for business, because if a company is really strong and a private equity firm that owns it is really strong, and it is, I would say, lightly capitalized or lightly levered, so something that might be a BB rated loan if it were rated in the market, the banks are pretty aggressive at pricing that these days. So you can't help but say that, yeah, they are a competitor for some of those deals. But they just, at this point, unfortunately for them, don't have the same balance sheet access as they used to. There's no way for them to shorten the syndication process or make it more certain. So the market has grown. It's a massive market, and their market share, frankly, has shrunk compared to private credit's market share, but there's still plenty of business for them to do and a growing pie for us to do business as well alongside.
What do you think are the most important variables in terms of building a sustainable advantage in a private credit strategy, whether that's an individual fund or a platform at a whole?
It starts from the beginning, which is sourcing. You really need to have good sourcing people, but sourcing doesn't just mean having good people that have good relationships with private equity firms. Sourcing also includes sector expertise, people who are analysts that cover a certain sector very deeply. They know the management teams. They go to the trade shows, not trade shows involving finance, but trade shows involving that particular industry's regular trade. Then I think the next thing is just good underwriting. You want to be able to make good choices and avoid landmines. There are certainly landmines out there, and it's easy to step on one. I think finally, discipline around structuring. Oaktree does the sponsor lending, first lien sponsor lending that is I think, more regular way, or has become more flow-based. But we also do a lot of complicated lending, rescue lending, sector-specific lending, such as life sciences, asset-backed finance, which is highly structured. So having a strong discipline around structure, and especially in those more complicated situations, is also important to having that sustainable advantage over the long run and to put up good returns that are stable and consistent for the investor base.
I imagine each of those categories comes into play in different portions of the cycle as well. Do you point to any one of those categories, sourcing, underwriting, structuring, right now in this environment as being a key differentiator?
I would say sourcing for sure, and then structuring is the other one. And for different reasons. I think there's two things going on in the market at the same time. So in the case of regular way new LBOs that are appropriately structured, which there are many of in the market, in the pipeline, having good sourcing, having good relationships, being top of mind for our partners, that's critical to kind of winning that deal flow. But at the same time, there is a growing level of stress in the tail of the market. The tail being LBOs that were done maybe in 2019 or 2018 or 2021 even, when base rates were near zero, never contemplated 5% SOFR. Some portion of those borrowers are going through stress right now. And in the next 2 years, we'll also be coming up against maturities. And so there is a discussion or discussions going on with private equity firms as well as non-sponsor owned businesses that are up against both cash flow and maturity issues. And the discussion quickly turns to, what could you do for me to help me bridge through this challenging period? And that requires that discipline on structure in rescue lending. I think in our opportunistic credit areas over the next 2 years, there's going to be a considerable portion of rescue lending opportunities. And so underwriting and structuring will be critical at that point in time. That card is unfolding as we speak.
In the beginning of that answer, you mentioned regular way deals. I think we often see in markets, once something can become securitized, it has this regular way structure. The market identifies it. It ends up growing that market significantly and has all types of knock-on effects. Is that something that you think about thematically at all? Creating new regular way structures which become adopted by the industry as a whole? Is that anything that ever plays into your mindset when thinking of strategically?
We do. It's hard to really spend a lot of time or resources on building a new product that way because you just don't know for sure what the buyer base looks like. But I think that generally speaking, the market is always looking for ways to get diversified risk and return. So for example, an institutional investor that might have billions and billions of dollars in sponsor-led first lien direct lending and still has billions that they want to deploy in similar risk-adjusted return, they may say, look, I just can't double and triple down and sponsor first lien anymore. This is just a lot and it's all correlated. Oaktree, what could you do? What could you give me that's differentiated, either in terms of structure or in terms of end market exposures? And so we are always looking to innovate to satisfy the investor demand for some sort of diversity. An example of that is our life sciences lending area. Life sciences companies, their performance is uncorrelated with GDP. If they're good at curing cancer, it doesn't matter if we're in a recession or not. The credit-oriented performance of the business, it just is what it is based on their ability to both innovate scientifically and commercialize. So when we launched that area, there was a lot of interest in it because it had as good or better returns than first lien sponsored direct lending, but it was uncorrelated. And it was good from an ESG perspective. These are very clean manufacturing facilities. The drugs and products are changing lives or saving lives. So we're always looking for things like that that could help satisfy a need. But I wouldn't necessarily say that we're focused on securitizing as a pathway to achieving that. It's just more of, is there a product that we think that we have the resources and the history to deliver?
Securitizing is a dangerous word. Anyway, I think it gets thrown around and can have some negative connotations. On the life sciences example, I'm just curious to dig into that a little bit more. Early stage, those businesses essentially look like call options. I imagine that you're underwriting later on in the process. When you talk about identifying that opportunity, the lack of correlation to GDP, is that mostly similar underwriting, but just a unique sector? Or is there anything creative that's done with the underwriting that's also differentiated?
Yes, early stage is a binary outcome. It's venture lending, it's venture equity, and that's not what we do. Our typical borrower has a product or two or three that are either post FDA approval or our loan to them is contingent upon them getting FDA approval. And so the use of proceeds of our loan are two things typically. One is to commercialize those drugs, hire a sales force, package the drug, et cetera. The second use of proceeds is to fund the clinical trials of drugs in the pipeline. So we get comfortable that our position is covered by the drugs that already are selling, but they use the proceeds to support their pipeline and growth. So a lot of these businesses are in that transitional phase where they have revenues and the revenues are growing rapidly, but they're using all of the profitability from those revenues and then some to build out their pipeline. That's the typical borrower. There are much larger borrowers out there that have enterprise values in the many billions. They're able to get cheaper financing than a private loan. They're able to get often IG bonds, investment grade bonds. And sometimes we see those businesses engaging in royalty finance. And those are things that we would consider as well. As you can tell from that description of these businesses in that transitional phase, structure matters a lot. Sizing your position matters a lot because if the business is worth $500 million, you don't want to lend them $500 million because the outcome could still be negative in that they could take your $500 million and burn it in the clinical trials for their pipeline. And then you're 100% LTV leverage. So you got to size your position appropriately. You have to structure it that if things go badly, that you stop the bleeding. And then we also provide carrots too. And the carrots are milestones. So what we say is, okay, well, look, you're building out this pipeline. If you really do a good job of developing drug number 2 or drug number 3, we'll lend you more on the same terms and we'll commit to that up front so that the management teams of these businesses, they could go back to the lab and really work on scientific innovation. And if they do a good job with it, they know that they have access to even more capital. And for us, it's a great deal because usually as the companies are developing science, they're actually de-risking our credit position as well. It's a great win-win if they're able to do that.
It's a great example. I mentioned regular way before, but in this example, the more creative, thoughtful structuring is so important. And for an industry, which I think is just incredibly important. We'll say that all are, but I think this one, I think we would all agree, has a little bit of a different meaning. When you think about the landscape of opportunities like that, are there other sectors that you identify that either are starting to grow in that sense with that same type of creative financing opportunity or evolving that in the future you could see it happening?
I think life sciences is probably on the tip of the spear on that, just because you have to know the science really well and you need to know structuring really well. And the nexus of those two is fairly unique or hard to come by. Technology generally, one would think would be in that same realm. But I find that technology businesses, there are very few companies in the in-between inflection point. They're either really, really early stage and they're venture equity or venture debt candidates. And that's not something that we do. Or they're very large businesses and they're getting LBO'd by the likes of some of the really big and great private equity firms out there that know software. The in-between, there's usually some sort of real credit risk associated with them. Like, for example, they might have only one customer and that customer is potentially just going to shut off the business. And so it's very hard to get comfortable lending against a situation like that. I think another area of lending that's interesting that needs capital right now is actually infrastructure lending. There's a lot going on in terms of constructing digital infrastructure, especially. And the banks appear to be sort of fully tapped or approaching the condition of being fully tapped. And the private credit universe will more and more need to kind of come in and provide that type of financing, both for stabilized assets as well as construction lending. I think that's a big area of growth. I don't know that the structure per se is going to be as detailed as something like a life sciences deal would be, but there certainly is a need there, a use case there for more capital, more private credit capital to fill that void. And then rescue lending. It's not really answering your question, Matt. I mean, you're asking about sectors, but a type of lending that structure matters a lot is rescue lending because these are challenging situations. You want to be able to protect your position and still provide capital to a company to kind of weather a difficult period. So every one of those types of situations is bespoke. The conditions surrounding that particular company's issues are usually different from one borrower to the next. So I think structure matters a lot there too.
unifying theme across the board there is a need from capital. You see it in the digital infrastructure, these CapEx budgets that are coming out, and it has to come from somewhere. Rescue lending would be potentially a similar need for capital. So certainly can see how that would tie together. One of the things we haven't touched on yet is the size and the importance of the size of a fund or a strategy in private credit. We had Mark Lazary on one of our other podcasts this week, and he mentioned if he was allocating to credit, it pains him to say, but he would want to make sure that the size of the fund was large, and that's absolutely important to compete now. I think for public investors, that usually gets tougher the bigger you get to compete, but in the private markets, it makes a lot of sense. Can you talk about those dynamics and how important a role they play just strategically?
Bigger generally is better in the private market, but I would provide a few notes of caution. So I would separate the answer between performing private credit and opportunistic private credit. Mark Lazary might be talking about opportunistic. I'm not sure. Mark obviously does a lot in opportunistic investing himself. But in opportunistic credit, bigger size is a huge advantage. The reason is, especially in something like rescue lending, and if you think about the size of LBOs that have been done in the last 5 or 6 years, there's a multi-billion-dollar LBOs with multi-billion-dollar publicly traded bank loans out there. So if you're a private equity firm that needs a $700 million solution, you don't want to have to go out and talk to 30 counterparties. You really want to talk to one or two, and you want them to write a $700 million check quietly and quickly. And in exchange, the lender gets the terms that they want. So size, speed, and certainty matters. If you're able to deliver size, speed, and certainty, then you're able to get the legal and economic terms that you want as a lender. So that's for sure an advantage. Now, in the public markets, especially something like distressed debt, a lot of investors said, well, or would say, well, bigger is probably not better because that means you just have to get more and more exposed to a company by the time you're able to exercise your will in a restructuring. And maybe it's better to be nimble, get in and out of a capital structure quickly. So I could understand that. But in terms of opportunistic rescue lending, size, bigger size matters a lot. Now, in the performing private credit area, bigger generally is better too. However, there is sort of a natural limit. And the reason is this. A private equity firm doing a $2 billion LBO, a $1 billion term loan facility. Well, there are probably 5 lenders, 6 lenders that could write a $1 billion check on their own. But a private equity firm doesn't want a single lender in a $1 billion facility. They want maybe 3. And so, yes, having a big fund and being able to write that $1 billion check or to commit to the $1 billion check gets you a very important seat at the table. But you don't get the full $1 billion check. And so there is sort of an upper end of the fund size where you just find it hard to fill the boat because the private equity firms are generally not doing $10 billion LBOs with $5 billion private financings. The fund sizes may exhaust the capacity at the moment. But size, it is certainly better to be bigger in private credit so that you can speak for that certainty on a $500 million deal, a $1 billion deal. And knowing that you might not get that full allocation, but speaking for the size and the certainty certainly is an advantage.
We appreciate the nuance, which is usually the case with most of these things. There's nuance to it. You tapped into some of the different instruments that are in the market, and I'd love to hear from Oaktree's perspective how you think about the suite of different private credit products that you have, whether it's a BDC product, traditional private credit funds. We have CLOs that are in the market. When you think about all the different instruments and how they work together, maybe just from a business perspective, how do you think about Oaktree's own offering and any dynamics that come into play with those?
So we have a very large private credit team. We have people that are entirely sourcing oriented. We have some people that are sector specialists. Actually, most of our analysts specialize by sector. So the way we view it is we have a lot of capabilities in terms of just breadth of capabilities and depth. And then the containers that we have, the vehicles that we have sort of sit on top of this big pool of people that could deliver. Now, one of the things that we find to be really great risk-adjusted return is large cap first lien sponsored lending. It is a huge market. It's the market that was dislocated when the banks stepped away 18 months ago. We think that when we look at these structures where private equity firms are writing 60% plus equity checks, and the spreads that we're earning are 500 to 550 over in the current market environment for large deals. These are companies that are worth at least $1 billion or have 100 million of EBITDA or more. So these are really large businesses, important businesses, to get paid 10 to 12% to provide first lien lending in that type of category. We think it's great risk-adjusted return. So we have something called Oaktree Lending Partners. That is a fund managed by this big pool of private credit investors, but with that very narrow focus in a big market opportunity. Similarly, we have other vehicles that tap into the breadth of the capabilities that'll do some rescue lending, maybe some mezzanine finance, maybe some first lien on a best ideas basis. So we look at relative value between life sciences and mezzanine and sponsored lending and rescue lending. And we'll say, well, what's the best idea we have at this point in time? And so we have these sort of best ideas types of funds, which include our BDC vehicles. We have a publicly traded BDC. We have a semi-liquid BDC as well that take a best ideas approach to both the public and the private markets, actually. When the public markets dislocate, but if the private markets are not dislocating, we say, well, that really doesn't make much sense. Why don't we lean into the public side, which we did in early 2022 when the public market was dislocating and the private wasn't. So that's the way we think about it. We don't have people necessarily tied to vehicles. We have this big private credit platform that services all of our private credit vehicles. And we try to deliver products to investors, both retail and institutional, that we think are differentiated and have the ability to sort of supply them with something that they need in their portfolios.
Internally, you mentioned that you have people that are essentially working across the strategies. How does that work? Just in an example of a deal, is it allocated across funds? If you have a large sizable deal, what goes into that decision making and where does that even sit? Is there a role that's played in terms of deciding that syndication, essentially?
We have an investment committee for Oaktree Direct Lending. And there are 4 of us on that investment committee, and we decide, A, is this good risk at the right price or not? And B, we have operational folks that sit alongside the investment committee that help us determine where do we have the need for that type of exposure. It's a cash management exercise as well as a portfolio management exercise. So for example, if we have cash available in a fund and we have room for that particular industry, we're not overexposed from a portfolio management perspective, we say, okay, if we like it for one fund, we like it for every fund. That's kind of our starting point. If we like it for one fund, we like it for every fund. And then we overlay, well, do we already have too much exposure to this industry? Do we already have too much exposure to this sponsor? Is this loan accretive to the portfolio based on its vintage? Should we reserve their last remaining bit of cash for something else? Maybe a rescue loan that we know is coming in 3 weeks. But I think the starting point is the same, which is if we had our druthers and if we didn't have investment guidelines in any particular account, if we like it for one account, we like it for every account. Now, there are also times where we work with our opportunistic credit strategy and we do a big loan together. So for example, in the middle of COVID, we did a $1.25 billion DIP loan to LATAM Airlines. Now, that's a big loan. We moved very, very quickly. We were able to write that check with the combined power of both performing private credit and opportunistic private credit. And we even put that in our BDCs. Now, it's a emerging market loan, which typically you don't see in a BDC, but we really like the risk-adjusted return. It was a rescue loan and a differentiated position or investment that we think was very well protected from a downside perspective. And our performing private credit team worked with our emerging markets team and we worked with our opportunistic credit team to drill down on LATAM and I think unearthed an opportunity that we think was outsized in terms of return versus the risk that we were taking on.
And was that a single loan given, or was there separate tranches within the loan between the two strategies?
We all participated in the same tranche. We typically do not participate in different tranches of the same capital structure. We have a compliance function at Oaktree that really we just don't want interfund conflicts generally.
Conflict of interest. Makes a lot of sense. Talking a little bit about risk management, I think the first portion of risk management comes before something comes into the books. But once it's in the books for private credit deals, I would imagine when there's challenges, it's not something you just sell into the market where there's a liquidity on the other side. Can you talk a bit about those dynamics and what it's like to manage that book of risk?
Well, we try to head them off to begin with. First of all, we try to make no one position large enough that it's that damaging. So highly diversified portfolio. We look for diversity by region. So for example, we have private equity funds that invest globally. We have private equity funds right now that have investments in the US, Europe, and India in the same fund. So as we think about diversity, we look at foreign borrowers, we look at currency risk, vintage risk, our expectations around refinancing, access to the capital markets in that particular, for that industry or for that particular region. We want portfolio diversification by sector. And we're largely first lien in our accounts, but we do very closely monitor how much sort of junior exposures we might have in those accounts that allow for junior exposures. Now, obviously, once in a while, you will have a tough situation. Oaktree, across all of our strategies, have strong restructuring expertise. Even within our performing private credit business, several of our team members are former distressed debt investors. And we have the ability to kind of work things out on our own within the team. But we also have people down the hall in our opportunistic credit strategy that are restructuring experts. And that's what they do day in and day out. So it's easy to walk down the hall and say, hey, here's a situation. Who's the right advisor for this? Do you know somebody at this other shop? We hear they're around. We hear that they're around the situation or want to be involved in the situation. So there are considerable resources that we have. There isn't really a playbook per se, but we do know that we have tremendous resources. Oaktree was founded in 1995, so we're almost at our 30-year anniversary. But even before that, we launched our distressed debt strategy in 1988. And so just kind of having that longevity, the reputation in the market, the relationships, that helps for all of our strategies at Oaktree in the unlikely event that we have a challenging situation to get through.
Very much in the DNA. I would imagine there are funds out there, well, I know there are funds out there that don't have those same type of resources. Is there any type of secondary market for direct lending, private loans that are out there? Is it a meaningful size? And from your perspective, is the risk reward ever there of stepping into something else that somebody has underwritten?
There really isn't a market per se. I think that's the short of it. However, there are situations where you might be in a private loan with a few other lenders. One lender, for one reason or another, wants to get out. For example, it might be a hedge fund that is experiencing redemptions and wants to get out. Oftentimes, the trading of that position is monitored or traffic copped by the private equity firm that owns the business. They say, okay, you want to sell, go sell, but you have to sell it to one of the other folks in the consortium. And so it's not a market process, it's a negotiated process, and it's a very inefficiently negotiated process. So if you did find yourself in a position where you want to sell, it's generally not a good outcome. Now, there are situations where there have been portfolios sold or LP interests in credit funds sold, and it depends on what's happening in the markets overall. If it's a clean portfolio and it needs to be sold for some liquidity reasons, well, there may be buyers for it who have had inflows into their direct lending funds and they say, I just want to get exposure. And we've seen trades like that at the portfolio level over the last few years in healthy markets where the average dollar price has been near par. And it's really just because there's just been inflows into the market and a manager needs to get exposure. But if you have a challenging position or if you have a portfolio that's kind of at the end of its life and it's just got 5 troubled positions in it, it's really tough to get that sold at any sort of reasonable price. The market is just not efficient enough and transparent enough.
Yeah, on both sides, it feels like it would be difficult to get a deal done. Going back to the distressed market, there's Oaktree's DNA has been there for a very, very long time. In my own experience, it felt like the distressed market that I read about was much different than the distressed market that I experienced, where it was large players, it was very proactive. Oftentimes, if something did get to restructuring, it had already gone through so many additional financing that there was a 1.5 lien tranche and all types of things mixed in there. Just over the course of your career, how much has that market changed? Am I way over exaggerating the dynamics? Is this more of a cyclical situation? What would you point to there just in terms of the distressed market?
So the market has changed. During the financial crisis, it was largely a marketable securities opportunity. So you'd identify the companies you want to invest in. You'd sort of have a target price in mind that you want to create your position at. You would endeavor to buy a third or more of the bond tranche or of debt of the business so that you could control or at least block a restructuring. And that was facilitated through big bank trading desk operations, as well as levered vehicles that blew up during the financial crisis. These special investment vehicles or SIVs that had mismatched assets and liabilities. Today, you don't really have that. The owners of debt are long-term owners. So in the case of CLOs or collateralized loan obligations, they're holders of that debt. They don't need to sell. Even if it defaults or if there's a triple C, they don't actually need to sell it. There are bad things that may happen within the CLO, but the CLOs are self-regulating mechanisms. The only place where you sometimes see selling pressure is if you see a sudden institutional or retail withdrawal from a vehicle or a market where all of a sudden there's a bunch of selling pressure. But since the global financial crisis, those periods have been very short. Even if you think about COVID, the depth of the buying opportunity was only about 2 or 3 months from March to maybe June. That's really when you saw most of the paper actually trade. And so on the public side, as a distressed debt investor, you have to be very nimble. You have to have a lot of conviction and be willing to move quickly in those short periods of time. So as a result, distressed debt has become more of a private credit oriented exercise where you're looking for consensual rescue loans, working in partnership with the private equity firms that own these businesses. It's a very different mentality these days versus before. And what you described as kind of the layered caking of capital structures, that certainly happens for sure. And it's probably going to continue to happen, I think, with rescue loans that are probably going to kind of roll through over the next 2 or 3 years as maturities happen. What you'll probably see is some number of them resulting in rescue loans that are first lien, but then grabbing collateral that hasn't been pledged to the existing loan. So that's a little bit of a layer caking that occurs. And then there'll be other situations where there's a holdco pref rescue loan that comes in that delevers the first lien and makes it refinanceable. That's probably a little bit of a healthier situation in terms of clarity in the capital structure that so-and-so coming in is clearly junior, but ahead of the equity and earning equity-like returns for taking on that type of subordinated risk. It's hard to predict exactly how that all turns out, but I think the biggest change in the distressed debt market is the drying up of liquidity in the tradable credit market.
One of the other dynamics about private credit, which can sometimes attract the cynics, is the marking of the books. And I think you referenced a very interesting period of time there with COVID, where you had this moment, quarterly mark, which was right in the heat of things. And fast forward just a few months later, and everything had snapped back essentially to par and beyond that in the future. Can you talk a little bit about anything that you would say in response to whether it's the volatility and the difference in terms of private credit versus public credit, or just the practice of bookmarking in private markets, whether there's any pushback that you would have on the cynical approach to it?
It's easy to be cynical about it because if you look at that period of time, COVID was sort of early March, mid-March 2020 is when everybody went home. And then the marks for the March 31 book came out in late April, mid-May kind of thing. So when you looked at those marks and you looked at the public marks, there was a big delta. This is very high level and generic, but I would say private credit books generally mark down 6 to 9 points for that quarter. And public credit, especially bank loans, probably marked down 18 to 20 points. I think if you looked at the bank loan market on average, the index was probably low 80s-ish by mid-April or late April. And so a lot of folks, the skeptics, would say, well, is private credit really that much better? I mean, in terms of credit quality versus where the market is telling you this type of credit should be marked. It turns out that private credit was probably right in its marks in the following sense. Private credit marks its books based on fundamental performance of businesses. But secondarily, they also mark it based on a change in market spreads. Now, at that point in time, yes, there was a change in spreads, but it gets impacted by expected duration of the asset as well. Having roughly a third of the markdown, a third to half of the markdown that you see in the public markets felt kind of healthy because on the fundamental side, there was no way to know what any one of these businesses would end up performing like. Nobody knew whether company A in the private market or company B in the public market was going to implode or be just fine. Nobody knew what the stimulus would look like. It was sort of the best guess that the private credit market can make. And frankly, with all the stimulus, most everything snapped back pretty quickly within 12 months. So I think that also leads to a little bit of a misconception about the private credit market, which is, this is just really opaque and people are playing with the marks. While I understand that skepticism, I think that there is a fair bit of transparency in private credit. And a lot of these private credit positions are held across multiple BDCs. But if you look at the 40 Act regulated private credit vehicles, they do mark their books to fundamental performance every quarter. They do provide information on their calls about things like fixed charge coverages and what their leverage ratios look like across the portfolio. You could compare those marks to other publicly traded BDCs as well. So while you don't have company by company performance disclosed with that level of specificity, you can get pretty comfortable that if a BDC has a mark of X, you could get comfortable that there's a real basis for that mark based on performance. And it is supported oftentimes by third-party valuation agents that are employed by these BDCs. And those valuation agents work across BDCs. So they know what someone else is marking the same position at and what sort of fundamental drivers, both positive and negative, another manager may be assuming in coming up with that mark or advising what that mark could be.
We'll start to wind down this conversation. It's been absolutely excellent. You mentioned before the power of Oaktree's platform and being able to pull off something like the LATAM Airlines deal. You've combined with Brookfield. There was the Brookfield acquisition. Can you talk a little bit about that, whether it's changed the strategy at all or opened up opportunities at all, anything that you would point to there, as we've seen consolidation in the asset management space become more and more common over the years? Just curious about the experience and the strategy with Brookfield.
Brookfield is an asset to Oaktree. Brookfield has not changed anything that we do. It's, I would say, only amplified or supplemented things that we do. Brookfield has a huge balance sheet, and they move in size and conviction when they believe in the people and the strategies that are part of the Brookfield ecosystem. Brookfield doesn't do much in credit on its own. Oaktree is really the key partner in its credit area, but they have huge businesses in private equity, renewables, real estate, and infrastructure. And the knowledge base that they have in those areas can be an asset to us as well. And when appropriate, we do sort of reach across and ask them that question. But Oaktree is managed independently. We have an independent board. We have an information wall up between the two institutions. We have complete autonomy over our investment decision making. And Brookfield has made it clear that they're there to help as and when needed. So it's been a fantastic partnership. It's worked really well from my perspective and from Oaktree's perspective generally. We kind of have a lot of things, I would say, in the hopper from a growth perspective that make a lot of sense for Oaktree to execute upon with Brookfield's help, both in terms of industry knowledge, but also in terms of balance sheet.
And for the last question, I'll keep this somewhat high level in nature and allow you to answer it however you like. But we tapped on a lot of the different market dynamics as it relates to private credit today. But is there anything that we haven't talked about that you've been thinking about a lot that can be very specific, like the Fed, which we almost avoided talking about? It could be outside of private credit, like AI spend or something along those lines. But anything that you've been spending more time reading about or a market dynamic that we haven't talked about that you would mention?
There's a lot to unpack in terms of discussion around rates as well as the election. I think the markets for a while, and maybe still, were saying, oh, look, inflation is kind of heading in the right direction. That means rates are going to come down. I never quite understood why those two statements make a lot of sense side by side. The Fed does not have a mandate just to reduce rates for the sake of reducing rates. The Fed does not have a mandate to support asset prices. It really has a mandate to support stable economic growth as well as employment. So I don't see inflation just heading in the right direction being a reason for the Fed to reduce rates, unless and until there's a recession or some meaningful shock that causes a risk to stability of the economy. So I think rates stay high for an extended period of time. I think that's a good thing if you're a saver, you're a creditor or a credit investor. So I think it's a great time to be a credit investor rather than equity, at least for the medium term. But I'm also a little concerned about the rate picture. With the budget deficit in the US being what it is, with the cost of interest of the US economy or the US Treasury now approaching something like $1.1 or $1.2 trillion just for interest expense, You just think about the amount of debt that needs to be printed just to roll debt and pay for our own interest. And we don't have in the US the political will to change spending or to increase taxes, which just means that the Fed's balance sheet is going to have to grow and to buy up the treasuries that the Treasury issues. And at some point, I'm just a little bit worried about where that breaking point is. And it's easy to craft an argument that long-term rates become unruly, which would be devastating to asset prices and asset values, and maybe even the economy overall. So that to me is a big problem. Now, when you overlay the election, I think you have both candidates that are probably just going to continue to spend. They both believe in deficit spending. So there's a lot of rate and Fed-related risk, I think, that could unfold over the next 12 months, depending on who becomes president. And I think it's a really serious consideration, because if rates go up from here, which I don't think is an unlikely condition, but if rates do go up from here, either because of political shifts or because we just don't have a choice but to issue debt to pay for interest expense, I don't think the market's really ready for that. And I think that there could be a crisis of confidence, consumer confidence, as well as corporate confidence, that could cascade into a recession if that were to occur. So that's on my mind. I don't know if that's what you were looking for, Matt. Maybe that's a little bit, doomy and gloomy to end this session on, but that is what's on my mind.
Well, we're talking credit, which the credit versus equity, it would fit the characteristics, but I think it's a great point. It's something that I think is in most people's in the back of their head, and they just hope that it stays in the back of their head in terms of the national debt levels and when that eventually gets addressed. It's a good thing to bring up because it's often one that we just kind of try to forget about. And the election being somewhat of a catalyst for that is a really interesting point. Thank you very much, Armen. This has been an absolute masterclass in all things private credit and credit in general. So thank you for joining us.
Thank you. Thanks, Matt. Really enjoyed it.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JOINCOLOSSUS.com.
A quick note before you go. If you are a company hiring or a candidate looking for your next opportunity, make sure to check out joincolossus.com/recruiting. We launched our recruiting efforts at the end of last year. We started working with firms that were interested in tapping into our audience. And after seeing some early success, we want to open this up to additional firms and to candidates who are proactively looking for their next opportunity. So we are mostly revolving around the investment world and the tech industry. But again, make sure to check out joincolossus.com/recruiting for more information.